In South Africa, all professional financial planners are members of the Financial Planning Institute of Southern Africa, the FPI, who is in turn affiliated to the International Financial Planning Standards Board based in the USA. Internationally, the FPSB, the International Standards Board, control the Certified Financial Planner designation. In South Africa, we have 4,700 professional financial planners registered as certified financial planning professionals with our FPI. Globally, we have in excess of 170,000 professional financial planners spread across 26 member countries across the world. The CFP, or Certified Financial Planner designation, is beyond any doubt the most prominent internationally recognized professional designation for a professional financial planner.
Endowments are fantastic products for people with a high tax rate. And in the past, they were sold to people who didn't need them, education policies. And usually that was to somebody who didn't even have a 20% tax rate, but it was a good savings vehicle. If you look at them in today's context, where we've got a trend of increasing capital gains tax and increasing income tax rates, it's really important to be tax efficient. So when I talk about tax efficient, an advisor can put you into an endowment that's incredibly flexible, that will allow you to have a share portfolio in it, that you've got a wide variety of investments to choose from. And the costs, again, need to be managed. Otherwise, all the tax benefits are not going to be there for you. So when I talk tax benefits, your tax rate needs to be more than 30% to enjoy the benefits of an endowment. Endowments are taxed at 30%. Your capital gains tax, likewise, is much cheaper in an endowment. It's going to be down at about 12% compared to in your personal tax capital gains tax environment, you're at 16.4%. And trusts benefit from being in an endowment. So consider your family trust being invested via an endowment for investment flexibility, and then again the tax efficiencies.
I think it's fair to say that investors want to maximize the return of their savings over their lifetime, whilst experiencing or minimizing the risk on those portfolios. And so it becomes a juggling act, trying to maximize returns and minimize risk. And this process involves creating a portfolio that includes a number of different asset classes: equities, bonds, property and cash, and offshore equities, bonds, property and cash. And the key is not to include so many risky assets that the investor experiences volatility when markets go through times of volatility, that the investor is inclined to want to sell assets at the very wrong time or deviate from a longer term strategy. The idea is that when markets go through very volatile times, that the investor continues to experience that volatility and not deviate from the longer term strategy. And the key here is to determine the optimal strategic asset allocation, or that optimal strategy for the investor. And this is important because we know that strategic asset allocation, or asset allocation, explains 90% of the variability of returns over time, basically meaning that it's more important to get your exposure to bonds, equity, property and cash right, as opposed to trying to get the call to invest in either Richemont or Mondi or Capitec, for instance.